The 18-year housing cycle is on the verge of collapse. This is a very consistent housing cycle that plays out over generations in America. Home prices have started to get cheaper, and they will likely continue to get cheaper based on this 18-year cycle collapsing. This is data that you as a home buyer or investor need to pay attention to so you can understand when to buy a house in 2026 and beyond. And the good news is things are likely to get cheaper from here. And here's why, everyone. Today, we're going to be talking about this 18-year housing cycle. And what this 18-year housing cycle is a very predictable, cyclical nature to the housing market where there's run-ups and recoveries, midterm recessions, further expansions, and then big crashes. And we are on the precipice of another big crash. In fact, this has already started, everyone. Home prices are going down in half of America already. In some cities, they've already crashed. Those are the warning signals. But you can see here, we're moving from the cycle peak to the deep recession. And the thing that concerns me about the housing market right now is how overvalued it is. So you can see if we look at the last 75 years of the home value to GDP ratio in America, you could see that we are in a massive bubble today. Home prices relative to GDP in 2025 are 162%. This is similar to what they were in the 2006 bubble, 16 to 18 years ago, which is how we get that 18-year housing cycle. And you could see previous peaks in home price to GDP ratio were 17 years prior, 8 years prior, and 21 years prior. So the housing market in terms of housing valuation follows a very consistent cyclical trend. But what's concerning about the current times is that we've never really seen before this bubble outside of 2006, and now this bubble is starting to deflate. And I know there are those of you out there who might be skeptical at this point of a housing market crash or a housing market downturn. You might be saying, Nick, you've been talking about this the last 4 years and it's only happening in a handful of cities. So why should I listen to you? Well, folks, this next graph I'm going to show you is going to prove the point about why the national housing market hasn't crashed yet. Why we're seeing all the warning signs build up across the housing market, but the national market hasn't crashed. And it has to do with unemployment, everyone. Take a look at this graph. The blue line is the home builder months of supply on the market going back 65 years. Home builder months of supply. And you can see we have one of the highest months of supply on record right now for home builders. But take a look at the yellow line, the unemployment rate in America. The unemployment rate, which historically surges after builder inventory surges, has not yet surged. Unemployment in America is still near a record low level, 4.2%, while the builder inventory is going through the roof, and while the national housing market is in a massive bubble, according to the home value to GDP ratio. So I just wanted to lay that all out for you right now. We are in the second biggest bubble of all time based on home value to GDP, a bubble which is starting to turn over. We are also in the third biggest bubble of all time based on builder inventory months of supply. However, that unaffordability and that builder months of supply has not yet rolled over into a full-fledged labor market recession, which is why the national housing market hasn't crashed. So that's the lay of the land right now. The question is, are we going to continue to dodge this full-scale labor market recession, or will it inevitably rear its head in the next couple of years? The U.S. government, they keep doing massive deficit spending. They printed $5 trillion during the pandemic. And oh yeah, by the way, they banned foreclosures for like 3 or 4 years during the pandemic, more or less, restricting supply on the market, preventing this recession from happening. Ultimately, that's why the market has yet to officially collapse on a national level. But as I dug into this 18-year housing cycle, everyone, more in depth, there were some really interesting things that started popping up. The builder months of supply, folks, I want you to focus on this because it's amazing actually what you can learn when you look back through history and you can see where we are in time right now. Home builder months of supply, which is how many homes are for sale on builder lots relative to sales. You can see it's 8.9 months of supply in 2025, which is the highest level since 2008, which was 17 years ago. Interesting, folks. 17, 18-year housing cycle. Now, before 2008, the previous high in builder months of supply was in 1990, 8.1 months of supply. And the previous cycle before that, the high in months of supply, was 1974, 16 years prior. So you can see how this housing market works on this consistent rhythm, this consistent drumbeat, 16, 17, 18 years. And what we're seeing with the builder months of supply today is that we are at this inflection point where there's all these homes on builder lots, all these homes that people aren't buying. That's a signal of the housing recession. That's a signal of the slowdown. For the people also that continue to deny that there's a housing recession, this graph is full proof that there is. The builders are already experiencing it. They typically lead the housing recession. The question is, what comes next? And what comes next, folks, is an interesting array of scenarios that I think is going to come next, not just in the next year, but the next decade. Over the next decade, over the next 5 to 10 years, what are we going to see as this 18-year housing cycle collapses? Well, we're going to see a couple of things. First of all, home prices and mortgage rates are going to get cheaper. Home prices and mortgage rates are going to get cheaper. We're exiting an inflection point of mass unaffordability, moving into more affordability. Home prices and mortgage rates are going to get cheaper. In addition, home builders are going to cut back production of homes. Given how much supply the builders have on the market today, they're going to cut back production the next 5 years. That's what they typically do after they reach this point in the cycle. But I also think we're also going to see unemployment start to go up at this point in the cycle. And I'm going to show you some more graphs right now, everyone, so you can get even more in depth into this concept of the 18-year housing cycle. One thing I love doing, everyone, and I actually got this graph from Reddit on the 18-year real estate cycles. I love looking back through history so you could see the previous cycle peaks. Now, according to this graph, which comes from the Reddit thread, Georgism, I guess, cycle peaks occurred in 1954, 1972, 1990, 2008, and they're calling this cycle peak in 2026. I really think this cycle peak happened more like 2024, 2025. But they're calling this cycle peak 2026. And they're calling this year 2025 the winner's curse, in the sense that like there's people who think like, oh wow, the market rebounded after its mini recession in 2022. It's never going to go down. There were these additional people that bought back in, just like there was additional people that bought back in 2006, 2007. Right? There was additional people that bought back in 1989 thinking there wasn't going to be a downturn. And then we had the deep recession in real estate occurring from 1955 to 58, 73 to 76, 91 to 94, 09 to 2012. And they're saying here it's going to be 2027 to 2030. But there's some interesting caveats I have for you guys about what this deep recession in real estate is going to look like and how it's going to impact different markets. I'm going to get into that as this video goes on. But first, let's take some requests, everyone. I am live right now. It is October 20th. It is a Monday. October 20th. I am live right now from my office in New York. I'm actually on the road in New York. We have a commenter who's asking, do I have future plans to separate condo data from single family data on Reventure app? Yes, I do, folks. That's coming in the next month. In the next month on Reventure app, we are going to have condo and single family data separate. What about some other comments here? I wonder what the new lumber tariffs will have on the supply of homes and remodeling. Well, lumber tariffs, I think, might cause some reduction in home building. But folks, what's going to cause the reduction in home building is the fact that the builder months of supply is already at 8.9 months. Builders have already permitted and built so many homes that they can't sell that they're going to just cut back production because of that. People like to blame everything on tariffs, but this is like, a market that's already moving in that direction. Well, let's see. Another question is, Nick, are there any plans to add stats on delistings to Reventure app? We would love to do that in the future. No immediate plans. Cody Walton says the 18-year cycle was Fred Foldvery's model, a Georgist libertarian economist. That's good to know. That's where this model in the 18-year housing cycle comes from. Another person says buy silver and gold and then sell for a home. Now that's really interesting, everyone, because if you've been paying attention at all to the markets here, you might be noticing that gold prices are going through the roof. They're up 4% today. Everyone, gold futures are now $4,300 an ounce. I mean, folks, this is wild. Gold was like, prior to the pandemic, gold was 1900. No, it was even cheaper prior to the pandemic. Prior to the pandemic, gold was $1,200 an ounce. Now it's $4,300 an ounce. Now, a lot of people look at this gold price and they think a couple things. First thing they might think is that massive inflation is coming due to the fact that gold is going up. They think of the 1970s. That was the last time that gold went up like this. was we had a big inflation. Some people say maybe you should buy a house right now, given the fact that gold is going up so much. You guys can let me know what you think. Are you guys buying gold? You holding gold? I think personally, folks, if you have to take my opinion, I think this looks a bit like a speculative bubble in gold. Wall Street Journal actually just had an article on this. Is gold in the grips of a speculative bubble? And I think this is also important to pay attention to in the talk of housing. This is all long-term super cycles here. Cycles in commodities, cycles in precious metals, cycles in housing. And, some people are thinking that, gold is now showing that, you should buy gold, that we're going to see more inflation in the future. However, folks, be very, very careful. There have been periods in the past where gold went way up, like in the early 1980s, and it then proceeded to collapse for the next 2 decades. I'm not saying that's going to happen again, but we had a similar upturn in gold from 1976 to 1980, and then it literally plummeted by over 50% the next 20 years. So people have this perception that gold never goes down. That's not true. Gold just only 30 to 40 years ago crashed. So I'm not saying that's going to happen again with gold. However, be very careful jumping on this bandwagon that everyone else seems to be jumping on in terms of gold. Now, again, housing, gold, people often relate them together, but I think the big problem I see in the housing market right now, everyone, is this home value to GDP graph. Because, some people like to say, oh, you should buy a house today because real estate always goes up. That's what people like Dave Ramsey like to say. They say real estate never goes down. But what those people totally ignore is the current valuation level of real estate. If housing is trading at 162% of GDP, and the way this graph is derived is looking at the aggregate value of residential real estate in the US, if it's trading at 162% of GDP, well, how much room does housing actually have to go up if it's gone up so much more than our economic growth? That's what this is showing, is that housing has went up way more than our economic growth the last 13 years. The time to get into the housing market was here in 2012, after the last crash. The time to get into the housing market was in the 1960s, when housing was only 79, 80% of GDP. You could see each new cycle in housing since the 1960s, we're seeing a bigger and bigger peak each time in terms of real estate. And for those that don't think that this is going to come down again, I mean, folks, what are you looking at? What are you thinking about? Like when you look at this graph, give me one solid argument when you look at this graph about how home values are going to perform well the next 10 years. And again, I talked about it before. Why haven't we seen the outright crash yet? The unemployment rate is still only 4.2%. So now we have 70 years of unemployment rate data. You can see we are not yet in a labor market firing recession. We are in a labor market hiring recession. They've stopped hiring. Hiring rate is the lowest it's been since 2007, 2008, yet the unemployment rate is only starting to tick up. But just look at this graph, everyone. Just look at the long-term trend. What happens when the unemployment rate historically starts to tick up? It goes up by more. And there's lots of people who try to convince themselves that this isn't going to happen this time around. They say, oh, we're going to dodge the labor market recession because of AI. We're going to dodge the labor market recession because Trump is president. A lot of people say stuff like that. But folks, the economy works in long-term cycles. The housing market works in long-term cycles. And you can only put off the inevitable for so long. And, ultimately, folks, you guys can let me know what you think. Do you think the housing market's going to crash, or do you think it's going to keep going up? And if you think it's going to keep going up, I want you to answer this question in the comment section for me. How is it going to keep going up when it's already outgrown GDP, inflation, income, and rent so significantly? And when we know the only reason why prices haven't seen more downward pressure is the fact that unemployment's still artificially low and that not enough sellers yet feel the pressure to sell. It's very true, actually, in some respect. A lot of sellers do come to market and they try to sell their house, and they ask 500,000 and it's only worth 400,000, and then they yank it off the market. In the short term, there's a lot of that happening. And I actually just had a conversation with someone in Tennessee a couple days ago. I was eating dinner at a steakhouse at the bar at the steakhouse, and I was talking to someone next to me who bought her house in Tennessee 3 years ago. She bought her house for $1 million 3 years ago in Tennessee. And she said to me, should I sell my house now? And I asked her the question, well, what are you going to price it at? And she said this, I need to get at least 1.1 million is what she said. She said they did 50,000 in renovations, so she needed at least 1.1 million. I told her, you're not going to get 1.1 million if you listed it at that. And she's like, well, I'm probably not going to sell it. So we do have a lot of sellers or would-be sellers who just like refuse to even list their house or consider the notion that they could lose money because they have no real reason to sell. They don't have the pressure to sell. But you know what would create the pressure to sell for a lot of people, everyone? An increase in the unemployment rate. We're at a 4.3% unemployment rate today. How long is that unemployment rate going to stay at 4.2, 4.3% when we're already seeing all the signs of a labor market slowdown? The hiring rate is dropping. The hiring rate's at the lowest level since 2007, everyone. And there's actually going to be another impetus to cause people to sell that I'm going to show you here in a second. We're going to look at some data on mortgages in America and the percentage of mortgages at different interest rates. We're going to look at some of that data, and we're going to look at data on mortgage defaults as well. Because the one key piece that is different in this cycle so far is we haven't seen the mortgage defaults increase. So when are the mortgage defaults going to increase? That's another thing we would need to see in order to unlock big home price downside would be an increase in mortgage defaults. But let's take a look at some of your comments, everyone. What are you guys thinking and feeling out there this Monday? One user is saying, it's a simple case of demand and supply. When prices continuously go up, demand goes down, and hence the bubble pops. What a great point. When a lack of affordability reaches a certain point, it just creates a downturn in the market. People can't afford to buy these houses, $500, $600, $700, $800,000, so the demand goes away. The existing home sales are at the lowest level in 30 years. Let's see, what else are you guys saying? One person saying, do you think realtors have made this worse by falsely telling sellers they can sell homes for crazy prices? They are incentivized by higher prices because that gives them more money. This is a really interesting comment. Do you think realtors have made this worse by falsely telling sellers? Now, folks, I'm going to actually give you the opposite. I think realtors are actually trying pretty hard to get sellers to list normally. A realtor isn't interested in the seller getting the max price. A realtor is interested in selling the house. And so often what will happen in a conversation with a realtor and a seller is the realtor will say, hey, you should list it for 480. And the seller is going to be like, no, we're going at 520. And then the realtor just says, okay, because they want the listing. That's actually how it typically goes. If you want to blame anyone here for the high prices on listings, it's actually owners and sellers. It's not realtors. The realtor incentive is to get the seller to sell it at whatever price it needs to sell at. It does not benefit a realtor to just have an overpriced home sit on the market and not sell. In fact, that looks really bad for them. Another person saying, billionaires in Blackstone buy low and sell high. This is disaster capitalism. Yeah, I mean, I've seen quite a few homes from Blackstone-owned entities where they're selling homes at losses. That is something that's going on in this market right now. Oh, Manny wants me to address deportations. 2 million have left so far. What do you think about deportations? Well, this is a very unique aspect to this housing cycle, actually, is the demographic situation in America. And I think this is a really interesting topic for us to understand. How do deportations, how does lower immigration, and how does the crisis in like lack of births and more deaths, how does that cause the shift on the landscape of the housing market? I'm going to pull some data on that for you guys right now, because I think that's really interesting. And I think the first thing to understand in the short term is that immigration is plummeted. Immigration is now likely at the lowest level in over 5 decades. It might even be negative. So normally immigration is almost always positive. There's almost always more people moving in than deportations out or immigrants leaving. But for the first time, a lot of different articles are saying we might actually have negative immigration in 2025. What's the impact going to be on the housing market? Well, it means incrementally less housing demand. Clearly, right? If we're not growing our population or our population is contracting, that's going to be an incrementally less housing demand. The nuance, though, that a lot of people miss with immigration is that it's not actually so much something that hits the for sale market. It's more the for rent market. So, people coming over the border or even people coming with an H-1B visa, they're generally not immediately buying a house with a mortgage. More likely, they're renting an apartment. So the slowdown in immigration is now having a big impact on the rental market. We're seeing the rent growth disinflate to the lowest level since, I believe it's about 2011. So 2025 is the worst rent growth for landlords since 2011. It's 1.4% rent growth this year versus I think it was like 1.3% in 2011. So that downturn in rent growth, I believe, is heavily linked to the slowdown in immigration. And it's just yet another indication of where the housing market is heading overall. Because if rent growth is decelerating when mortgage rates are 6.5%, what is rent growth going to do when mortgage rates go to 5% and home prices drop? Rent growth might go negative because you're going to have an increase in home buyers. So I think that downturn in immigration is now hitting the rental market, which is something that's eventually going to hit the for sale housing market. So that's how to think about the immigration. But the other problem here, folks, is the births in America and the fact that we don't have enough births. So let's see if I can actually find this graph for you, everyone. Or I might just have to make it on the fly. Oh boy, let's see. Stick with me here for a second, everyone. I'm going to show you data on births and deaths in America, but first I have to find the graph. So basically, the U.S. Census Bureau every year comes out with different estimates on how many people are being born in America, how many people are dying, how many people are moving in. And every year I take the data and I aggregate it for you guys and I show it to you on this channel. And I think, okay, here we go. Now, this is just really interesting, folks. We're actually looking at Orlando, Florida here. So this isn't national, but I could show you some different areas. In Orlando, Florida, international immigration in 2024 was 44,000, right? Domestic migration, Americans, was minus 19,000. So Orlando lost 19,000 Americans in 2024, but gained 43,000 immigrants in 2024. Now, we don't have this data yet for 2025, but what do we know? This immigration figure is likely to crash back down or go negative. So what is that going to mean for a market like Orlando? What is that going to mean for a market like Dallas? In Dallas, look at this. International migration, 48,000. Domestic migration plummeting. So in many of these markets, the domestic migration, the Americans moving in and out, was already heading into a negative tract, a negative territory, but it was being masked by the fact that international immigration was propping everything up. But I think the really interesting thing is the births and the deaths, everyone, because this is kind of like a long-term trend on the housing market that we've never experienced before. How many births are there versus how many deaths are there? And let's see. I'm doing this on the fly. I apologize, guys. I didn't have this graph ready. I thought it would be ready, but let's just see here. So we're comparing births to deaths. And you can see really the blue line here is births. The red line is deaths across America. And we have an issue, and it's the fact that the births are going down over the long run, and the deaths are going up. So this is just going to cause a structural reduction in home buyer demand, lower births, more deaths. That's going to cause a structural reduction in home buyer demand in the long run, and it's going to cause more people to be forced to sell their home. Now, the births and deaths, this is not a short-term thing. This is not something that tomorrow is going to lead to like more inventory and a crash in prices. But it's just kind of a headwind, a long-term headwind for the housing market. And again, for those who think like, oh, the market's never going to crash, it's never going to go down. This is just another thing to add on top, is that demographically, we're losing immigrants, births are going down, and deaths are going up, with the only thing keeping the market afloat being that unemployment rate at 4.2%. It's literally the only statistic really still supporting the market is that low unemployment rate, which translates to that low seller desperation, right? The sellers in most markets are not yet desperate because the unemployment rate is still 4.2%, 4.3%. Now, some of you in the comments said you think the unemployment rate's 20%. I would disagree with you. If the unemployment rate was 20%, sellers would be freaking out. You'd see listings 3 times higher and massive price cuts. The low unemployment rate is what explains why prices are still high. And the reason is because unemployment filters through to mortgage defaults and foreclosures. And this is the other piece. When are we going to see the increase in foreclosures? When are we going to see the increase in mortgage defaults? Are we going to see a repeat in the 2010 cycle as far as that goes? And how does this all relate to the 18-year housing cycle, the mortgage defaults and foreclosures? That's an important thing to understand because we also have not yet seen a meaningful increase in mortgage defaults and foreclosures. They're, getting back to the long-term norm, but they're not yet anywhere near what we saw in 2009, 2010. And there's a couple ways to think about that. The people who are bullish on the housing market, and if you are bullish on the housing market, feel free to leave a comment in the chat. But it's likely some of you are saying, oh, market will never crash because everyone has a 3% mortgage rate and the mortgage defaults are still low. That's like some type of argument that a lot of housing bulls give, that the market will never crash. But I would actually flip it on you guys. The fact that home prices are already going down in half of America without a meaningful increase in mortgage defaults shows you actually how unstable the market is. And the fact that if mortgage defaults even go up a little bit due to a response and increased unemployment, you could have a potential big downside in prices. And I think this is really interesting too, because this graph, folks, and I'm giving you a lot of long-term data in this video. So, it's important for you guys to kind of stick with it. I'll kind of summarize everything for you as we go along so you can understand where we are in this 18-year housing cycle and what it means for when and where you should buy. But for now, we're looking at the mortgage default rate and the unemployment rate. And why is this an important combination of metrics to understand? Well, the unemployment is in blue. Mortgage default is in orange, percentage of mortgages in default according to the Mortgage Bankers Association. You can see that these metrics are basically identical to each other. Basically identical over the last 25 to 30 years. And so, why did we have a big increase in mortgage defaults in 2008, 2009, 2010? It was because the unemployment rate skyrocketed. It wasn't just because there was bad mortgages. It was because a lot of people started losing their jobs and the unemployment rate went to 10%, which facilitated a 10% mortgage default rate. Now, folks, some people say, oh, that could never happen again. Well, take a look at what happened during the pandemic. During the pandemic, the mortgage default rate actually went to 8.2%. During the pandemic, we had a mortgage default rate almost as high as we did in 2008, 2009. But guess what? We never had foreclosures. We had no foreclosures in 2010, 2020, 2021 because they did all of the foreclosure moratoriums and the foreclosure bans. So again, folks, for those who deny that there's a housing downturn, for those who say, oh, Nick, you've been talking about this for 4 years, understand this: the amount of intervention by the U.S. government over the last 4 years, across both administrations, the amount of intervention is unprecedented. And that we had this 8.2 mortgage default rate that should have resulted in a wave of inventory and prices going down. It never did because they never went to foreclosure because they blocked the foreclosures. Now, I think with Trump 2.0, I do not think foreclosures are going to be blocked again. In fact, Trump 2.0 is taking away foreclosure protections, and thankfully they are. The FHA mortgage program, they're now rolling back the foreclosure protections. I think under Trump 2.0, we're actually going to finally see some of these foreclosures start to take place. So as this unemployment rate goes up, if it goes up, it's likely the mortgage default rate is going to go up, and you're going to see more foreclosures. So really important that you guys have that lay of the land. We're still in a record bubble. That bubble is starting to deflate. We're seeing signs supporting that on the home builder market. Builder months of supply is at the third highest level ever, a signal that we're going to see a continued improvement in affordability. The builders are probably going to cut back housing starts, which is going to lead to an increase in unemployment. And we're likely to see over the next decade cheaper home prices and mortgage rates while incomes go up, which will lower the burden of mortgage payments on income. That's just how the 18-year housing cycle works. That's just how the housing market works in the long run. And, let me know what you guys think about this. I'm actually going to take some requests here. What are you guys thinking? What are some markets you want me to look at? Someone is telling me I'm wrong on unemployment. Technically, unemployment stems from people being laid off, completely disregards people that have quit and have been unable to find a job. Well, it depends on the type of unemployment. There's different metrics for unemployment. And so, it's people looking for work who can't find a job, and that generally goes up when layoffs go up. Chattanooga, Tennessee, Quincy, Massachusetts. Didn't Trump 2.0 take away FHA for non-citizens? Yes, Trump did take away FHA mortgages for non-permanent residents. There was a big drop in mortgage rate locks for non-permanent residents. Slowest bubble ever, according to Ryan. Housing market's slow. It operates in 18-year cycles. I think we would have seen more price declines at this point if the government hadn't banned foreclosures, if the unemployment rate moved up by more than it did. But those things are lagging in this cycle, which is why it's an especially slow bubble. Brunswick County, North Carolina. Queen Creek, Arizona. Merced, California, 02169. Winter Springs, Florida. Northwest Arkansas. Wow, we have a flood of listings. We have a flood of requests. Let's get to these, everyone. Let's get to these. All right, let's go to Reventure app, everyone, and take a look at what's going on in your local housing market. What is going on in your local housing market? Let's see what is going on. So we actually just updated the data from Zillow for September. So we have September data on home values now in the app. And you can see the areas in red have increasing prices. The areas in blue have decreasing prices. Ooh, Northport, Sarasota, Bradenton down 9.1% year over year. Denver, Colorado down 2.9%. Austin, Texas down 5.9%. We're even seeing values go negative in Nashville, in Atlanta. So we're seeing really the Sun Belt, right? The Sun Belt has negative prices year over year. These areas in blue on Reventure app. You guys should go to www.reventure.app, type in your city or zip code to check this updated data for yourself. But let's take a look here. 30315. And I'm going to try to get to as many of your requests as possible, everyone, but definitely pay attention to people's requests. 30315. Well, coming in hot, everyone. South of Atlanta, minus 10.7% the last 12 months. Who's saying there's no housing market downturn? We have values down double digits year over year south of Atlanta. Show that to all the deniers out there. They're probably not going to want to look at it, though. They like to think of things in more general terms and just blindly focus on the national figures when we have a full-scale crash going on in and around south of Atlanta. Values down 11% year over year. We think they're going to drop another 7.2% over the next 12 months. You can see this is 3 years in a row of value declines. This was a market that got hit really hard in the last crash. I think we could end up down 25-30% here south of Atlanta when all is said and done. How about 37421? 37421 sounds like it's in Tennessee. 37421. Now this is in Chattanooga, everyone. Chattanooga is a cute little market to the southeast side of Tennessee. It's actually on the border with Georgia. Some fun facts about Chattanooga. If you guys have never been, I would recommend you go. It's in 2 different time zones. So you're like driving across here in Chattanooga, you go from Eastern to Central time. Kind of weird. If you're scheduling an appointment with a realtor in some neighborhood, it's going to be an hour ahead of where you think it's going to be. Chattanooga also, the metro stretches into Georgia. They also have a chicken factory in the downtown area that kind of smells, which might be why values in downtown Chattanooga are actually going down 1.9% year over year. But our request was for 37421, I believe, in Eastern Chattanooga. Values down 0.3%. So where do we think values are going to go the next year? Well, we think they're going to go down more, minus 4.9%. There's a big inventory pile up here in Chattanooga. This is a market that was holding on, but is starting to roll over. All right. Chattanooga. What else are you guys saying? What else are you guys saying here in the chat? Planning to buy a home in Prosper, Texas, but I see a lot of existing homes in the market. How is the current market in Prosper, Texas? 75078. When do you think I should buy a house? Ooh, Prosper, Texas, everyone. Now, this is north of Dallas, Prosper, Texas. This is kind of like, they just keep building in Texas, right? They don't stop. So Prosper is here. Okay, downtown Dallas is here. Little geography lesson. Here's downtown Dallas. Prosper is probably 30 miles north. The suburb before Prosper that was booming was Frisco. Now Prosper is like the area that's booming, but you can see values are going down in Prosper. Why are they going down? Well, because there's a lot of inventory on the market. You can see here we've actually had 2 of the biggest year-over-year declines in Prosper's history the last 2 years. We think values are going to drop another 3.5% the next 12 months. So this incremental downturn in Prosper, Texas, we think is going to continue going forward. We don't see like an outright crash playing out, but if you are buying here in Prosper, expect that values are going to continue to go down in Prosper. What about Park City, Utah? Have you guys ever been out to Park City, Utah? I've actually been to the Salt Lake City airport once. I've never been skiing though in Utah. You can see Park City is to the east of Salt Lake City, and we have someone looking here, 84098. Here we go. Now, this is an expensive area, everyone. This is like ski towns, chalets, ski condos, second and third homes. Typical value, $1.3 million in Park City. In the last year, values are flat in the zip code, 0.4% growth. Where do we think they're going to go the next 12 months? We think they're also going to stay flat the next 12 months. Why is that? Well, there's just not enough inventory on the market here. It's come up a bit, but inventory is actually down this year compared to last year. So we think this market is going to be a balanced market. Ooh, what about Madison, Wisconsin? Let's get a little Midwest action, because the Midwest is kind of a funny place, everyone. The Midwest keeps going up. You guys can let me know if you live in the Midwest. Have you ever lived in the Midwest? Do you want to move to the Midwest? Economically speaking, it's starting to perform better. I guess someone gave me a 6-digit zip code. There's no 6-digit zip codes. Let's see. Let's see if I can figure out. 53710, maybe 53710. 53715? There we go. 53715. Madison, Wisconsin. So this is downtown Madison. Is this near University of Wisconsin? We can see values are kind of up in most areas here of Madison. Values are still going up. And our 12-month forecast here, whoa, this is actually really funny, folks. It's a very kind of, it's an area with a lot of diversity. We have downward forecasts in certain zip codes. We have upward forecasts in other zip codes. Near the University of Wisconsin, we think values are going to keep going up. College towns might be doing a little better right now than some of the other areas in America. More resilient demand. They're not facing recession as much. Usually during a labor market recession, more people elect to go to school. Maybe this area is going to do a bit better in the future. All right, what about Pasco County, Florida, 34653? And folks, just to relate it to what I was talking about before, 18-year housing cycle, right? This is a long-term cycle. We are exiting the peak of this long-term cycle, and we are seeing values really start to go down in a bunch of different zip codes here. Pasco County, look at this, everyone, north of Tampa. We are north of Tampa in St. Petersburg here. Look at this, 9% drop in the last 12 months. 10% drop in the last 12 months. This is a drop that's already happened. 8% drop in the last 12 months. So again, we have more markets which are already going down, already exiting this 18-year housing cycle peak. Question is, how much more are these markets going to go down in the future? Oh my goodness, minus 10%. We have a minus 10% forecast here in, what is this, Newport Richey, Pasco County, 34653. We think values here are going to continue to drop. Minus 10%, folks. You see that score for your reventure zip code? That's good news if you're a buyer and investor. That means negotiate hard, everyone. If you see that type of forecast in your area, download the market report as well. Folks, you can download a market report under a premium plan. Check this out, everyone. You can download the market report. Let's see how quickly. 5, 4, 3, 2, 1. We're trying to improve the speed on some of this stuff. Here we go. Downloaded market report. Home price forecast 34653. Folks, take this market report, give it to the listing agent, give it to the seller, and be like, hey, seller, I know you're stubborn. Values in your market are going to go down 10% in the next 12 months. Here's my offer based off that. We actually just had a user reach out and say that they bought a house here in Florida using our forecast, and it really helped them. But folks, if you're in one of these markets with the big downward forecast, that's good news for you. That means you're going to have more options. You're going to have more negotiating leverage. We have someone asking about Charlotte. Is Charlotte growing too fast? Let's just look at the comments. Is Charlotte growing too fast? Lately, it feels like everyone from California, New York, and New Jersey, and even Texas moving here, and I still see a lot of homes for sale. Well, I think Charlotte was growing fast. I don't know if it's still growing fast. But we can answer that question, folks. So, if you're a home buyer or an investor or a seller and you're, looking in your market and you want to understand, is my market growing too fast? Is it a good time to buy? Is it not a good time to buy? Let's take a look here. Charlotte, North Carolina. This is a metro that also stretches into South Carolina. Values are down 0.7% in the last 12 months. So values have started to turn down. Now, are a lot of people still moving to Charlotte? We can also answer that question with Reventure app. What's the domestic migration? I just went to Investor Metrics and picked domestic migration. How does it look in 2024? It's still positive. Definitely still a decent amount of people moving to Charlotte. It's not as much as it was, though, during the pandemic. And then you look at the housing inventory, and you could see, ooh, wow, housing inventory in Charlotte's going way up. 10,000 homes on the market in Charlotte. Highest level in a decade. I would say that indicates a slowdown in people moving in. Probably good news if you're a buyer. We have a question here. What areas with wealthy people are down? This is the wealth cap. People with money are moving to Naples, Florida, Greenwich, Connecticut. Political climate. Florida, no property tax coming. What happens then? The question is, are wealthy people supporting certain housing markets? And the examples were Naples and Greenwich, Connecticut. Well, there is definitely a bifurcation in, how people are doing in this economy, depending on if they're wealthy or not wealthy. That's undoubtedly true, right? But let's take a look at Naples. Is Naples dodging this crash? No, Naples is not dodging this crash. Naples, Florida, everyone, down minus 7.8% in the last 12 months. That's the biggest downturn in Naples since 2009. So this is a market. I still think a lot of people in Naples have a perception that, oh, it can't go down. Oh, it is going down, folks. It's already going down. Data from Zillow available on ReventureApp shows a 7.8% year-over-year decline in home value growth. Great news if you're a potential buyer. We here at ReventureApp think values in Naples are going to drop another 4.1%. Naples is an area with a lot of wealthy people, wealthy retirees. Now, what about Greenwich, Connecticut? What about the bridge? Basically, it's in the Bridgeport, Stamford metro area. Values are still going up here in Connecticut. So this is a wealthy area. Values are still going up. And you can see in New York, Connecticut, upstate New York, down into New Jersey, values are still going up everywhere. This is still a hot market around the tri-state area. In New York City, values are still going up. So I would say wealth does play a component, but what matters a lot more are the dynamics on inventory and demand and migration flows in your market. Let's see. Apparently, some people in the chat, our neighbors, went to the same high school together. That's cool. All right, what else? Please do Miami Springs. New Jersey got 2-bed, 2-bath, 55-plus homes going for $700,000 in New Jersey. Wow, that's expensive. What about Henderson, Nevada? My wife and I are ready to buy, but houses doubled in price since COVID. I don't want to immediately be upside down. Nevada is always an interesting market, everyone. Nevada kind of has similarities to Florida. It's a big tourist area. Henderson, values are starting to go down in Henderson year over year, but you can see they're up 40% the last 5 years. So values are starting to turn down here, but they're up 40% the last 5 years. Where do we think they're going to go in the next 12 months? Minus 3.1% is our 12-month forecast for Henderson, which is to the southeast of Las Vegas. You can see we have a lot of shifting downward forecasts now in Las Vegas, a lot of blue on this screen. So if you go to www.reventure.app, everyone, and you hit home price forecast, you can see this home price forecast for your zip code. And when you look at this home price forecast for your zip code, you kind of immediately get a window into where the market's going in the short term as we exit this 18-year housing cycle in the U.S. Ooh, interesting. Dallas-Fort Worth. What is going on in Dallas-Fort Worth? Big metro. Actually, it's our #1 metro for users on Reventure app. Dallas-Fort Worth is our #1 metro for users on Reventure app. Values are down 3.8% the last 12 months in DFW. This is another big Sunbelt boomtown. Had a lot of people moving in. A lot of people said values would never go down in Dallas-Fort Worth. They are going down. Minus 3.8%. Where are they going to go the next 12 months? Well, let's look county by county, everyone. We're going to change the view to county view on Reventure app. We're going to go from metro to county. I would encourage all of you guys to check out these different geographic views for your area. And let's look at home price forecast. You can see we have a downward forecast in all of these counties surrounding DFW, whether you're in Collin County, Dallas County, Tarrant County with Fort Worth, Denton County. We have -5 to -7% forecasts over the next 12 months, which is great news, again, if you're a buyer. These negative forecasts, if they exist in your market, are good news. I kind of want to rewrite the script a little bit here on the housing market. A lot of people think downward prices is bad news. No, downward prices is good news. Downward prices is what allows you to get more negotiating leverage, get more affordability, and get back into the market. And ultimately, downward prices is going to be what causes home sale activity to go back up. Because folks, there's another data point I just want to show you here in the 18-year housing cycle. And it's an interesting one. It's something called the existing sales turnover, the percentage of existing homes that sell in a given year. Now you could see we went from 7.4% of existing homes selling in 2021 down to only 4.7% in 2025. So this is what, realtors and mortgage brokers really struggling a lot in this market because there's just really low sales volume. Only 1 out of 20 people are selling or I should say buying a house in a given year. 1 out of 20 people, low sales turnover, sales volume. You could see this data point also operates on kind of a similar cycle. 2008 to 2025 is the last trough to trough. That's 17 years. 1991 to 2008 was the previous one. That's 17 years. Then we had 1982 to 1991. That's 9 years. 1969 to 1982. That's 13 years. So again, folks, we're exiting this period. We're actually in this period of really low buyer demand. Really low buyer demand here. Really low transactions. What I think, though, is the buyer demand is going to come back up in the next couple of years as the prices and mortgage rates go down. You guys can let me know what you think. We have someone looking to buy in East Boston. 02128 made an offer of condo 3% below ask after a 10% price decrease. Folks, I love these requests from Boston. What else do we got? We got Wichita, Kansas as well. Let's look at some different markets. For those of you that don't know, I used to live in Boston. I lived in Boston for 8 years. Lived in Boston, worked in Boston. That's where I cut my teeth in real estate, actually. East Boston. Well, you can see in the center of Boston, values are going down year over year, and then primarily this is condos and townhomes. East Boston values are flat. $675,000 to buy in East Boston. That is crazy. You can see if we look at the last 20 years, there was a huge surge of growth from 2013 to 2018. This is actually like right when I lived in Boston. Since then, it's kind of deteriorated a bit. The appreciation has slowed. We think values in East Boston, Esteban, are going to go down 4.6% the next 12 months. So you are smart to be offering 3% below ask. I might go 5% below ask, though, based on this downward forecast. You're right to be trying to get a deal because this is a market that's shifting down. There's a lot of inventory in East Boston right now. And folks, go to www.reventure.app right now to access this data for your city and zip code so you can figure out where prices have gone in the last year and where our 12-month forecast is in the next 12 months. Folks, 12-month forecast next to MIT and Harvard, -7, -8%. MIT and Harvard zip codes. A lot of people wouldn't have expected that, but a lot of areas in Boston, the city of Boston, were forecasting downward prices. We go to the suburbs, we're still forecasting prices to grow in and around Boston, Massachusetts. We had someone talk about Wichita, Kansas. I love the diversity, by the way, of all of these different markets. Wichita, southern Kansas. Is it the capital of Kansas? No, I don't think it's the capital of Kansas. I think Topeka is. Let me know if I'm right about that. But Wichita, you can buy a house for $216,000, and I actually believe Wichita pays people to move there. They actually pay you to move there in Wichita. Our 12-month price forecast is -1.8%. So this is a market that a year ago, folks, look at this, was a big seller's market. Now it's become a buyer's market. Now this isn't a crash playing out, but this is -1.8 the next 12 months. So this is a market that's definitely slowing in Wichita. Now we have some users talking here about the stock market. I feel like the stock market needs to drop like it normally does during a recession for us to get a housing correction. That's a great point. I would say that's related to the unemployment rate. You know, the fact that the unemployment rate's so low, and the fact that consumer spending is still holding is juicing earnings, juicing stock prices. We'll see how long that lasts for. Okay, we're getting some California requests. We're getting some Washington requests. Florida, Arizona, Winter Springs. Oh, we got a seller. Seller in 9601. Want to buy in 9634. Also, Reventure app, maybe add the biggest employer of future things in the market, like maybe a business going there. That's a good suggestion, actually. Winter Springs, Florida, 32708. Overvalued 20% and why? Let's take a look at that. 32708. Another metric, folks, that you guys should take a look at is the overvaluation rate for your market. How overvalued are home prices in your market? And you can see here Winter Springs, which is north of Orlando, 27% overvaluation rate. So we have a user asking, why is it 27% overvalued? Well, let's take a look at the historical data. This overvaluation is also a key part of the long-term housing cycle. You can see Winter Springs used to be very undervalued. Now it's very overvalued. It's getting a bit better, but still very overvalued. And the reason why is the home value to income ratio. So we look at the long-term ratio of home prices to income in a market, everyone. And in Winter Springs, on average, home prices trade for 3.6 times income over 20 years. Today, they're trading for 4.6 times income. So that's how you know the market is overvalued. This is almost like a PE multiple for stocks. We're basically seeing houses trade for a higher multiple to income and rent than we've ever seen, and that's how we get that overvaluation figure on Reventure app. Now we have someone selling. I love when sellers here chime in, because the seller attitude is definitely kind of an interesting one. We have someone selling in Helena, Montana. Helena, Montana. Now I believe Helena is the capital of Montana. Let's see what's going on in Helena. Well, it looks like we just zoom out to the metro area here for a second. Values in Helena are up 2.4% in the last 12 months. Up 2.4% in the last 12 months. You can actually see values in Helena haven't gone down since 2011. We think they're going to be roughly flat over the next year in Helena, Montana. So if you're a seller, it's a pretty balanced market in Helena as well as a buyer. Now, someone wants to buy in Sherwood, Oregon. I'm seeing some decent price cuts already. Just wondering what this market looks like. We also have a housing market analysis on Hawaii. Oregon and Hawaii. What's going on in these markets? Oregon and Hawaii. Well, Oregon, folks, as we move to the state view on Reventure app and we go to home value growth year over year, Oregon is down 0.5% year over year. So Oregon's starting to see a little decline in prices, not by a whole lot yet. Where was the request? It was Sherwood, Oregon. Let's see here. So if you go to Reventure app, folks, you can just type in your city. You can type in any city actually in the US and quickly see the data. So Sherwood, Oregon, this is to the southwest of Portland. And actually, let's just zoom in on Portland, everyone. How's downtown Portland doing? Downtown Portland's correcting. -7% year over year in downtown Portland. My goodness. Downtown Portland is not doing well. Downtown Portland has seen year-over-year value growth, year-over-year value declines for, I believe it's 7 of the last 8 years. Wow. Downtown Portland is getting hit really, really hard. Might actually be undervalued. 47% undervalued in downtown Portland. I think a lot of downtown areas in the U.S. have taken it on the chin. I think that they can figure out, the crime issue in some of these areas. They could actually be good places to buy. But their question here was about Sherwood. -1.4%. This is a suburb to the southwest of Portland. We think values here in Sherwood are going to drop 5.3% the next 12 months. So this is a market that has shifted. This is a market that a year ago shifted into a buyer's market. Now it's a heavy buyer's market. So that's great news if you're buying in Sherwood. I would negotiate hard. I would get that Reventure report for Sherwood, share it with the sellers, and adjust your offer price based on it. We had a request for Hawaii. Now, Hawaii, sometimes people forget about it, right? We're looking at the continental U.S. Where's Hawaii? Where's Hawaii here on Reventure app? We got to go all the way out here into the middle of the Pacific Ocean. Now, Hawaii is down 2.9% the last 12 months. So Hawaii is correcting. It is starting to go down. This is a market that was holding on for a long time. Now it's starting to go down. Now, -2.9 doesn't sound like a lot, but it's the biggest drop in Hawaii since 2009. So it's meaningful. It's the biggest home price correction in Hawaii in 16 years. Again, folks, you see that 16 year, 17, 18-year housing cycle. It's happening even in these local markets. This housing cycle's turning. We think values in Hawaii are going to drop another 3% the next 12 months. We have a request here for 80211, Denver, Colorado, right outside the city, and prices are brutal. Hoping to buy next year, but need a massive drop. 3,000 square foot homes, well above $1 million. Wow. Denver. How did Denver get so expensive? A lot of the people from California bought up homes in Denver during the pandemic. The good news for you, though, is values are correcting all across Denver, folks. It's a sea of blue. In and around Denver, values are dropping. And in this zip code to the northwest of Denver, values are down 6% the last 12 months. Over the next 12 months, we think they're going to drop another 8.8%. And then, folks, take a look at this. In this zip code to the northwest of Denver, 6% drop. That is the biggest annual decline on record going back 25 years. So again, a lot of people try to say, oh, there is no housing downturn. A lot of people try to say, oh, it's not, oh, 6%, who cares? We are seeing the biggest annual declines in some of these neighborhoods that we have seen in 25 years, which is great news if you're a buyer or investor. And we think here in Denver, it's going to get even better for you, -8.8% forward 12-month forecast. So, when all is said and done, maybe this is a 20 to 25% correction. Selling a triplex in Spokane, Washington. Spokane, Washington. Well, if you're a seller and you're selling a triplex, that means you were an investor. You had it rented out. I would be curious what you're renting it out for and what your yield and cash flow is. Now, Spokane, northeast part of Washington, almost in Idaho, values are flat year over year. So it's a kind of, I wouldn't call it balanced market. It's shifted to a buyer's market, but values haven't really started to drop that much yet. We think they're going to drop more in the next 12 months. -3.9% the next 12 months in Spokane. There's a lot of inventory. So if you're selling that triplex, understand that the buyer is likely going to need to take out a 6 to 7% mortgage, and you got a lot of competition with inventory. So if you have to sell, I would price your house appropriately, price your triplex appropriately. Don't try to get greedy. Otherwise, you might just want to wait. 14127, according to JoJo, is way overvalued. 14127, is it way overvalued? Orchard Park, New York. Is this on Long Island? Orchard Park? No, this is Buffalo. Sorry, Orchard Park. This is where the Bills play, I believe. Correct me if I'm wrong on that. Do the Bills play in Orchard Park? Buffalo, folks, it is actually very overvalued. It's one of our top overvalued markets. You can see here, Orchard Park, 27% overvalued. For the longest time, values in Buffalo were cheap. Values didn't really go up that much, but then they went up 14% during the pandemic and have continued to go up. Interestingly, you can see in Orchard Park, around Buffalo, values haven't gone down by more than 1% in any year the last 2.5 decades. Very stable market. And we actually think, despite the overvaluation, we actually think values in Buffalo, Orchard Park area are going to continue going up plus 6% the next 12 months. That is wild, everyone. Inventory here in Erie County is non-existent. Days on market is pretty low. So prices are going to keep going up in Orchard Park. It's going to take a little while before we see that correction start to play out in Orchard Park. 90232. 90232. We got a request for 90232. And I love the diversity of requests here. Culver City, California, Los Angeles, Culver City. So Los Angeles is here, everyone. Culver City is to the west. A lot of tech jobs in Culver City. We're also near Santa Monica and Venice. Culver City's down 2.5% in the last 12 months. Typical home value is $1.7 million. Woo, that's expensive. How do we think it's going to go the next 12 months? We think it's going to be a minus 6.2% the next 12 months. So we have 3 years in a row of value declines in Culver City. We think another 6% is coming. Inventory is starting to pile up on the market. This is an area that we think you'll be able to buy. Someone says, oh, I'm a dude that just checks a website. Well, interestingly, I don't know if you know this, Bathwater Basin, but I actually built the website I'm checking. I'm not sure if you knew that. All right. 02780. 02780. Folks, I actually built this application, Reventure app, for you guys. And we just had our 2-year anniversary for Reventure app, everyone. October 19th, that was our 2-year anniversary. It's now been a live, viable software product for 2 years. And we've had over 1 million unique users. I'm going to start sharing some data for you all soon, just on how successful Reventure app has been, because I think it's time to actually start showing you guys some of that data. We've had over 1 million unique users use the site. Pretty wild. We have a request here. Taunton. Is this Taunton, Massachusetts or Taunton, Rhode Island? Either way, it's east of Providence. East of Providence. Values are up 2% in the last year. We think it's going to go up 3.4% the next 12 months. And yeah, 3% the next 12 months. Thank you, guys. Thank you for the congratulations on the anniversary. Oh, we have a request here for Manhattan, everyone. Manhattan. All right. Let's take a look at Manhattan. I actually love talking about Manhattan real estate because Manhattan real estate, folks, has gone down a lot. Manhattan real estate is down. Take a look at this, everyone. It's expensive. Manhattan's still expensive, but we're actually down about 20% from peak on Manhattan condo values, and Manhattan is actually undervalued by 29%. I think Manhattan could be one of the best places to buy along with downtown San Francisco right now. There are some legitimate concerns about what the new potential mayor in Manhattan and New York City is going to do in terms of property taxes and other things. So obviously you have to think about that. We don't know how that's going to play out. But in terms of pure valuation, Manhattan's undervalued and our forecast has now stabilized. So we had a pretty negative forecast on Reventure app for a while. It's starting to stabilize. I think Manhattan could be a good place to buy. What about Westchester County, just to the north of Manhattan? As they say, Westchester is the best Chester. And this is a really nice suburb to the north of Manhattan. We actually think values are going to go up 6% in Westchester in the next 12 months. Still is a really tight market, Westchester. And it's one where we just aren't seeing that inventory. So prices are up 3.3% the last 12 months. We think they're going to go up 7% the next 12 months in Westchester. Not a lot of homes for sale, not a lot of price cuts. DOM is still fairly normal. I actually really like Westchester. I think it's a great place to own real estate, especially if, say, there's another exodus. Say the new mayor from New York City does cause another exodus. A lot of people would be moving to Westchester to buy homes. All right, everyone. I think that about does it for today. Hopefully you guys enjoyed this video. We talked about the 18-year housing cycle. A lot of the data is definitely very clear. We're exiting that 18-year housing cycle peak, and we're seeing it show up in a lot of parts of America. We're not seeing it show up in Westchester. Westchester's still going up. The Northeast is still going up. Some parts of Boston are now going down, as we learned today. But I would encourage you guys to go to www.reventure.app and check out the data for your county, your city, your zip code on home value growth, overvaluation rate, and the home price forecast. The home price forecast and the overvaluation rate, these are going to be the two metrics that are going to really help you most as a buyer or investor into 2026. Until next time, everyone, this is Nick from eVenture signing